Well, yeah, I was just making an observation, which is crypto is full of experimentation. But then once in a while, a handful of these companies break out into the mainstream, and they've turned out to be better businesses. Stablecoin is an example. A tokenized dollar functions better than the US dollar right now. Exhibit A on companies is Tether, because Tether today has only 150 employees that have been there more than 12 months. I think they might have more than that now. But they're valued currently, according to the media, $500 billion, $3.3 billion per tenured employee. And they earned $20 billion, which would make them a top 10 most profitable bank. At $500 billion, they're second only to JP Morgan, which is valued at $869 billion. JP Morgan has 313,000 employees. Okay, so JP Morgan's valued at $2.8 million per employee. Tether's valued at $3.3 billion, and they're making more money than every bank in the world, and twice as valuable as Goldman. That's a breakout. Polymarket as a prediction market functions far better than the CME, but the real breakout was the 2024 election. The prediction market for Polymarket called 50 of 50 states correct. Nate Silver's model, New York Times, none of these models were even close. Only Polymarket called the election in 50 of 50 states. And as we just mentioned, Trueflation, to me, and I've watched its correlation to yields and spreads and even the curve, it's a better predictor of how markets are reacting. So Trueflation, which is a blockchain-based inflation tool, works better than CPI. And Trueflation comes out every day. So
yeah, the Trueflation thing I think is, to me, not so much like the end number. That's easy to kind of compare, but it's just the philosophy. CPI is a backwards looking static data. A lot of times, like, we're going to call you and ask you how much you could rent your house for, kind of crazy stuff.
Yeah.
That if you're designing from scratch, you'd be like, well, we definitely can't do it that way. Whereas Trueflation, kind of more first principles approach, says, why don't we just look at what houses rented for by looking on the internet?
Yeah.
Right. And get a real time feed of millions of data points per year. And grocery stores. Why do we send people physically into the grocery store? Why don't we just look at the prices online?
Yeah.
Or find other data feeds and things like this. And so it does feel like it's part of this big automation trend and kind of real time trend in society. But in a weird way, there's like a bifurcation in the stock market. Some of the greatest hedge funds in the world, they have access to this information, right? They constantly are seeking, they're taking pictures of the oil tanks or, Walmart parking lots or whatever crazy thing they're all doing. But then you have retail investors. And retail investors, they don't have a spreadsheet. Like, they're just momentum, vibes, and buying the dip. And if you look at those two groups, actually the retail investors have been outperforming many of the hedge funds. How do you kind of settle that, that difference between these two groups?
I have two possible theories, and I don't know which one is correct. Okay. The first theory I would point out is that if you have a room of geniuses, then the average person's a genius, or the best you can do is to be average. So if every hedge fund employs expensive tools, buys alternative data, but from the same vendors, they're all going to have the same conclusion. Because they all were geniuses and get an average result, which means there's no edge. The second explanation is that alpha is a finite source. And in the past, hedge funds took alpha from retail. And that's like why hedge funds did so well from like the 1980s through the mid 2000s. But now the hedge funds are stealing alpha from each other. So the net result is average results. And the reason they're stealing alpha from each other is that they all employ the same time frame. Retail actually operates more like permanent capital, right? They're discounting the future. A lot of our quant-based clients, 6 weeks is the outer limit of their time horizon. But how can anyone really decipher signal from noise 6 months forward? It's really difficult. Like, that's why anyone who's a Bitcoiner thinks decades ahead, and then they just ride through the volatility. That volatility is not what hedge funds can endure.
Another thing that plays into this, you've mentioned quite a bit of economic data. You've also mentioned quite a bit of, I think, analysis that you guys have done. You were showing before we started that the U Michigan survey results may be a little bit harder to trust moving forward. Talk about this as one example of why people are starting to have questions about some of the economic data that they're reading.
Yeah. People have taken for granted that surveys have always been done objectively or adjusted for what could be sampling bias. The UMich survey is the gold standard because it's been run for more than 50 years, and it's a measure of consumer expectations on everything from is it a good time to buy stocks, to buy a house, inflation. And it has an army of researchers. It's like a business at UMich. We've tried to contact them before, and we spent 2 hours walking through their methodology. It's an extensive operation. However, they provide the data, and so you can see the survey respondents. For instance, on the 1-year inflation, that currently stands at 4.3%. Which is
1 year from now, people think that inflation will be over 4%.
Yeah, which
collectively.
Is and that's the same level it was during 2022, during the inflation surge. Mm-hmm. So in other words, the UMich survey says consumers are expecting hyperinflation just like 2022. Mm-hmm. But here's the problem. If you look at the breakdown, Democratic respondents say it's 4.5 or 5.1. Republican respondents say it's 1. Okay. So obviously it's political when people answer. Like people who don't like Trump are going to say it's through the roof. In fact, of the Democratic respondents, 4% say inflation's 30%.
4% of Democrats who respond to the UMich survey say they think inflation next year will be 30%.
30%. So it's absurd, right? But the problem with this survey's not adjusting it for the generalized population. The U.S. is essentially 50-50 Republican Democrat. Mm-hmm. But the UMich survey now, 65% of the respondents in the past month were Democratic. And it was 49% 18 months ago. Mm-hmm. So now the survey is increasingly reflecting the results of Democratic views, which of course is causing the inflation expectations to spike, but it's not really spiking.
So is that something that is like malpractice in the methodology? Is that intentional? Is that just like naturally kind of flows over time and sometimes you get a little bit more Democrat Republican? Like how do you view that as, okay, I want to use this data point to in your research or kind of in your investment strategy? Do you throw it all out now and say, hey, we can't use this? Or how do you view it?
Yeah, so one of the issues is, of course, algorithmic systems and quant systems take that survey result and they put on trades. Mm-hmm. And the Fed has to react to that because the Fed cares about anchored expectations. And there's just 3 surveys they look at, that, the New York Fed, and Conference Board. UMich changed their methodology. They used to do telephone calls. They now do it 100% online. They email it to people. Are the surveys only being emailed to certain people now? Or are they only, is there a finger on the scale? We don't know, but the process has, I think, become polluted. Yeah.
And so do you guys now just disqualify it and don't look at that survey anymore? Well,
we still reflect it because, believe it or not, most of our clients will point to say, Tom, inflation's out of control. Look what the UMich says. And then as I try to explain to them the methodology from, they're like, how come you're the only one pointing this out? So
you're smart.
Yeah. So I think prediction markets are the answer. So I think poly markets of the world where they're like, what is the CPI a year from now, might be better signal than using these surveys. I mean, I think it's going to push us towards alternative data, like even using Trueflation is better than looking at CPI.
I am surprised at the explosion, let's say, of the prediction markets in sports betting. It makes sense, right? You're not betting against a house. You're not betting against a peer. The odds are a little bit better in your favor. It's easier, right? And there's these deep liquidity pools. There's more transparency. It's global. It's very clear to see why that is. But I'm also surprised that we have not seen more uptick of these prediction markets in kind of business and finance. For example, you're talking about CPI type inflation expectations, but also just things like, I always talk about like the Tesla delivery number. People will go buy the stock with the view that they're going to beat on deliveries, but they'll beat on deliveries and the stock will go down.
Yeah.
the prediction market isolates the data point. And so now you can just simply, speculate on that one thing, but we haven't really seen as big of an uptick in the finance community. Why do you think that is?
It's going to start changing because I think up until recently, Kalshi was the only market U.S. institutions could trade with transparency because Polymarket was offshore. So like this is the year where Polymarket is now also available in the U.S. It'll move in sync with the tokenized stock world. So as we tokenize equities, and what you're describing is what I call factorization of a stock. We're going to start factoring stocks once they're tokenized. Because, for instance, if you take Tesla, you can do two ways to factor it. One is Tesla as a stock can be deconstructed into a AAA bond and then an equity tranche, which is like earnings for 2026. And you do 1 year forwards for every earnings, and then the rest is a bond. That's how tigers and strips were created with treasuries. But the other factoring of a stock you can do is Tesla sales in China, Tesla Model X sales, and with combining that with prediction markets provides all the transparency you have. Plus, you can see the dollar amount bet. And for the issuer, they have transparency. This is what the market's now predicting for deliveries or earnings. And they can now surprise or beat expectations. So I think it's a huge unlock coming as we tokenize stocks.
One of the things that we've been talking a lot about is how the regulatory bodies will adapt to this. So for example, it would be illegal if you worked at Tesla and you knew that you were going to beat the delivery number and you went and you bought the stock, right? You're trading on material non-public information. That's not good. Very long history and precedent for not doing it. But if all of a sudden now you say, wait a second, I am somebody who works at the company that manufactures the windshields, and I have been able to do some data research, and I know that our private company, every time that we see spikes in manufacturing of windshields for Tesla, there happens to be 3 months later a rise in the number of deliveries. I'm going to go not buy the stock. Instead, I'm going to go into the prediction market, and I'm going to bet they're going to be done deliveries. Again, like you start getting in this weird world, right? Where you are financially incentivized, if you're the person who works at that windshield manufacturer, to quote unquote tell the world what you know by expressing it in the market. Where does that end? Like, where do the regulators put the box?
Yeah. Well, it's blurring a lot of things. It's like the joke, like, with the prediction markets, they were having the bet of like, which WNBA game is someone going to throw, a pro
green
dildo.
Yeah.
And then the person who put the bet on would just throw a dildo on the court. So you're right. But then liquid markets are big, so people can't influence outcomes. But then can people have a cheat code to get ahead of that? That's a great question. Today, like that definitionally is a little blurry anyways, because like if some company is doing alternative data and then they find a precursor data point that's like 90% correct, is that insider trading or is that just
like good
analysis, right? Yeah. So that's why the SEC uses the mosaic theory to determine if it's insider trading or not. I think surveillance won't be a problem in prediction markets if they use the blockchain, because then they can just track the wallets. And if someone made a big bet and they don't do other kind of bets and their bet stands out strange, or you know what I mean? Like it would be easy to actually forensically determine if it's an insider. So I think in a tokenized blockchain-based world, especially with whitelisted addresses trading, it'll be easier to catch insider trading.
What is your view 2026? Everything keeps going up. You mentioned an S&P correction of 20% earlier. I don't think people like hearing that.
Yeah.
Kind of what, maybe crypto stocks, et cetera.
Yeah. I mean, it's early in the sense I can give you some generalized thoughts, but like, I don't really have an idea of what the following year looks like until early December, because then we're only 1 month left in the prior market. Because this year, for instance, I think S&P gets to 7,000, right? But if we get to 9,000, then it pulls from next year. So price being a little unknown, I think there's a lot to be optimistic about in 2026 because one, monetary policy is easing, and that's room for mortgage rates to come down. And we know there's a huge pent up market for not only housing to become more affordable, like through allowing capital to build cheaper homes and stuff, but for people to have relief from mortgages. The ISM, which is the benchmark of manufacturing confidence, has been below 50 for 32 months, the longest stretch in history. But once the Fed starts cutting, companies can get more confident. So the ISMs recover. That's great for the US economy. We know there's onshoring next year. That's GDP activity. And then AI, I think, is becoming, as you just pointed out, like robots, agentic, superintelligence. These are huge innovations coming next year that are good for earnings growth. So I think the earnings picture looks good. But how much is reflected in the stock price? We don't know yet. Like if we exit this year at 7,000, then there's plenty of room for stocks to do well next year. If we end the year at 8,000, then we're going to have a 30% drawdown.